Hi, I'm Melissa Murphy from the Mass Agents Association and the Number One Agency. I'm here today with Marshall Katz. We're going to talk about flood insurance. The Number One Agency has a flood insurance program available through the Hartford. Marshall has a little presentation. We're going to go through a sort of potential selling situation, and he's going to go through my homeowners and flood insurance with me. I'm going to turn the mic over to Marshall. I hope you enjoy the presentation.
Now, one of the things agencies should think about selling flood insurance with every policy, so coverage is there should a flooding event occur. We all know that property policies don't cover flooding, and the only thing that we have available to us to offer is the NFIP flood policy. Why do we also want to sell flood insurance with every policy? So there's an appearance of professionalism versus just hawking monoline policies. Now customers say, wow, we've never had somebody go through all this like this with us. To create a revenue generating activity, again, selling flood insurance pays you commissions. Melissa mentioned coming through the Hartford program. If we write direct with NFIP, our commission to the agency is 15%. If we change it over to the Hartford program, it's 20%. We get 5 percentage points more for doing the same work for the same policy. So if you're listening and that gets your hot button, you want to give us a call. To also reduce the probability of getting any no claim and to have the documentation for defense if one arose. Now, Melissa, going over your homeowner's insurance program, we've determined if you had to replace your home, you're going to need $200,000 on coverage A dwelling of your homeowner's program. Now, one of the things homeowners programs allow are different deductibles. The deductibles that point where you have to pay the first $250,000, $500,000, or $2,500, and then the company pays after that. Well, if you buy a $250 policy deductible, your premium for the year is $650. But if you go all the way up to $2,500 deductible, it's only a $450 premium. You can save approximately $200 a year. Now, if you have a small claim, like an ice dam claim, and it's only $500, if you bought a $250 deductible, it would be covered, but it's probably not advantageous to you to put in a $250 claim, and we'll talk about that a little bit later. What I'd rather have you do is look over the whole thing that we're talking about and then make some decisions a little bit later, okay?
Okay.
Now, when you buy a homeowner's program, not only do you get coverage A dwelling, but you also get coverage B for detached structures. So that could be a detached garage or a storage shed or a swimming pool or a fence or anything else that's detached. Now, coverage C is your personal property. That comes standard at $100,000. So tables, chairs, clothing, lawnmowers, sporting goods, all part of that $100,000. Now, coverage D is loss of use. If you have a loss to the home where you can't live there, now you got to go to a hotel, you may have to eat out, dry clean your clothes, that's all part of that $60,000 worth of coverage. Now, it also has coverage E, personal liability, and in the quote, I gave you an automatic $300,000. What is personal liability for? When you do something you shouldn't have done to someone else. You're skiing in the Alps, you lose control, you bump into somebody, they go off the cliff, and the estate sues you. You're playing golf at the Cape this weekend, hit somebody in the head with a golf ball, they sue you. Coverage E, personal liability covers worldwide coverage. Now, it starts at $300,000, and I'm showing you $500,000 and $1 million right on your homeowner's program. And again, it can be $20 more a year or $30 more a year. Coverage F, medical payments to others, starts on the policy, $5,000. A friend comes over the house. He just got laid off today. The health insurance ended up dying with him when he left the job. And now he needs stitches, he breaks an arm, doesn't have health insurance. Your $5,000 can provide coverage for him. Does this make sense right now so far?
Yeah, so far we're making sense.
Okay, good. It makes sense. Good. But I'm going to hold off on this, and we're going to get back to it in a little bit. I wanted to explain the flood insurance program component to you.
Okay.
If we do $200,000 worth of coverage on your home, I highly recommend you do the same thing on flood insurance. So it starts at $200,000, you get automatic $80,000 in contents coverage, and that premium is $361 a year with a $1,000 deductible. Now, I always take this and plug it up there right away, because you're going to be in the background thinking, okay, flood insurance, but what does it cost? And you're not going to hear my next slide. So I want to let you know right away what the premium is and what the cost is for flood insurance right up front. Now, reasons to have a larger deductible on your homeowner's policy. A small loss could cause your homeowner's insurance company to non-renew your policy, leaving you with the state pool market at higher rates. So yeah, that's what policies are for, to have claims, but we also look at people that have claims, and maybe a claim could force you into a higher homeowner's premium. So why collect a $250 claim and your insurance might go up $100 a year? So that wouldn't be a good thing. A small loss will remove any loss-free credits you have credited on your policy have taken years to earn as well. So you could be getting $100 or more on loss-free credits on your homeowner's program that's taken you 8 years to accumulate under your apartment program. Now you're going to lose that in a heartbeat over a small claim. The loss could follow you for additional or newly purchased properties, causing increases in those premiums as well. So now you don't want this home anymore. 3 years later, you go to a new home, and they're looking at your losses from your prior property that could affect you on your new purchase. It frees up cash to allow you to purchase more catastrophic coverage game plan on your assets. Most everyone can afford $2,500 if something happened. Maybe through an equity line, maybe you have to take cash out of the bank, maybe you have to borrow from someone. But you can't afford to lose the $200,000 home. So that's the purpose of having a homeowners program with a flood insurance program. Your house burns to the ground, the homeowners insurance program pays the claim. A massive flooding occurs and your house gets wiped out. That's where the flood insurance program comes in. So what we're looking at here is we're looking at insuring your home on a catastrophic basis, not on a small claim basis. Reasons to purchase flood insurance: 25% of all flood losses happen in preferred zones. Now, you happen to be in a cheaper zone, so your insurance costs aren't as much as somebody, let's say, that's living right on the ocean. So right now, it's cheap, and it's a good time to buy it while it is cheap. But losses do happen in these preferred zones, and about 25% of a year do happen there. Flooding can come from overflow of lakes, rivers, streams, oceans, or water source, such as a neighbor's swimming pool, city or town water tower, or even an overturned pumper truck. Now, on the way to your home, I happened to notice one of the city's static storage units for their fire department, right up the hill from your house, uphill. So if that broke, where does water go? Downhill, and it could wipe your house out. And that would be a covered claim under the flood insurance program, because it would be an additional water source. Buying flood insurance now may lock your property into the preferred rating structure, even if the zone changes that would be good for you or even a purchaser of your home. What does that mean? To make it simple, and the way it was explained to me a couple of years ago by one of the folks from the Federal Emergency Management Agency, FEMA, let's say your premium's $300 now, to make the numbers easier for you to understand. The premium's $300 now. A couple years from now, when they get over the 2-year window that they're doing for allowing you to keep your rate, let's say your zone changes, and the bank now says, "Oh, Melissa, you have to buy flood insurance." Well, you already had, because you bought it now. But when it changes to the standard zone, your premium won't be $300 anymore. It'll move up to $800. But if you don't buy the flood insurance prior to the break-in period, then your insurance is going to go to $2,800. So it keeps your insurance at the preferred zone, but rated under the standard rates. So it's $300 now. It'll move to $800 because the zone changes, but it's better than $2,800. That's why we want to buy flood insurance before something happens. The purchaser of your home, what does that mean? You sell your home 3 years from now. The purchaser gets your preferred rate. The grandfathering clause under the flood program on that rate can be assigned to the new purchaser. So if they're looking at your home and they're looking at somebody else's home, the other home has a $2,800 flood policy, yours has an $2,000 cheaper a year on insurance. Which home do you think they might be interested in, yours or the other one. Especially if everything else seems equal, they're probably going to look at your home over the other home. So that's why we'd want to consider buying flood insurance to lock in the grandfathering clause. And you may be like everybody else, well, the government's going to help me. The last line here, the federal government doesn't really help much. Where there's a disaster, about 50% of the time, the president declares a declaration of disaster. When they declare a declaration, Congress may declare funding. What is funding? Funding is a housing and urban development, a HUD loan. It's a low-interest loan in order to rebuild your home. Well, gee, what if you or your spouse got laid off and you can't afford another loan? Well, then you can't take out the HUD loan. You might not even qualify for it. You still have to qualify for the loan. If you've had a couple of glitches on your credit rating, you're not going to qualify for the loan. You buy the flood insurance, now you've got the coverage should something happen. Does that make sense?
Yeah, that makes sense.
Okay, good. Now, here's the recap.
Okay.
This is where you're going to have to make some decisions. So, your dwelling at $200,000 has various deductibles that you can choose from. Which one of these deductibles do you think you'd like to take advantage of? In fact, let me give you that.
Sure. Well, based on everything you said about small losses versus larger losses and the premium I can save, I'm going to go with the largest deductible, the $2,500 deductible.
That makes sense. And what would you like to do for liability?
Liability, really the only thing that makes sense to me is the $1 million. For $30, why wouldn't you do that?
That's a smart decision. Very good. And what about flood insurance? It's your decision here.
You know, I've thought about it a little bit, and being able to lock in the preferred rate now, based on our zone and based on what the premium is, I think we're going to do it. So we'd like to purchase the flood insurance also.
Very good. And the only thing I would need now is your John Hancock on my form for the company. So if you could just do me a favor and date and sign. Perfect. And I thank you very much. And I thank you for coming with Number One Insurance Agency. Now, as a reminder to all of you, all the agents out there that might be listening in on this video, a little recap here of what we've been talking about. Having a little bit prepared like this, so it makes it easy to transition. And all it is transitioning from the homeowner policy to the flood insurance policy, and being able to apply the deductibles and show the consumer how simple it is as well, and that different deductibles allow them to buy different coverage. For every property policy you sell, have the following ready when the customer comes in for their review on new policies, renewals, or reviews. Property policy quote form, the flood policy quote form. Also have available the Accord 60 flood policy rejection form for those people that decide not to. If Melissa decided not to buy flood insurance, that's her choice. But I'm going to have the Accord 60 form there ready and say I'm required by my insurance company, which would be my E&O company, to have her sign off on that form. So have it ready. If flooding happened a year from now, 5 months from now, Melissa's property got damaged or destroyed, and now she's asking questions, why do I not have flood insurance? And again, I can give her a reminder that she signed the flood insurance rejection form. Information also on all endorsements and other policies integral to the customer's overall financial well-being in their insurance program is part of the thing that you want to have ready as well. And lastly, we hope you enjoyed the presentation and that it may be helpful to you in transitioning the homeowner policy quote to the flood policy quote. Questions about the video and follow-up may be addressed to myself. I've got my email address up there. Anybody have any issues or questions, feel free. Questions about signing up for the Number One Agency's Write Your Own program may be addressed to Ann Tobin. That's Ann's phone number here at MAIA, or atobin@massagent.com. So you get a 20% commission to the Hartford versus 15% from the NFIP. And also, when you're talking to Ann, if you have a book of business now, ask her about how easy it is to do a book roll. I appreciate your time, and get out there and sell some flood policies. Thank you.